let's talk about what the completed investment plan looks like first. First, you're going to have the template. It's actually 6 pages long. We encourage you to review it. As you do the reading, it's included in the reading.
So remember, you change the things in the yellow stuff.
And we'll finalize that on Wednesday. On Friday, you did Exhibit 1. Remember, you did your risk tolerance test. It changed your asset allocation. Then you came up with your asset allocation targets, current targets, and in retirement. You need to open that file because we're going to be using some data from that file today.
Okay, but this is what we did on Friday,
right.
These 2 things.
And what we're going to do today is we're going to work on Exhibit 2, which is building your paper portfolio. So we're going to be putting your asset allocation targets from here into this, and then you're going to be picking your individual assets. So the question is, how do you create your paper portfolio? How do you create a portfolio of assets? Are there things you should do and things you should think about? Again, this is your spiritual creation before your physical creation. So it's important that you consider risk as you build your portfolio. So even though there's different ways of building that portfolio, there are general principles that are applicable to everyone. And so we call this the hourglass bottom. So what's the first thing you should invest in? Number 1, we call it your emergency fund and food storage. In our family, we buy powdered milk. I grew up on powdered milk. I was so excited when my mom started mixing powdered milk, half whole milk and half powdered milk. And later when we got married, I swore that I would, or I didn't swear, but I just said I would never drink powdered milk again. So we still buy it every 10 years. Every 10 years, I'm happy to throw it away. But this is not a food storage glass. But that's the first thing. What do we do next? Notice next what we do is we divide our portfolio between taxable and retirement assets. What's the reason for this? And it's because certain types of assets, if you sell them before at least in the US, if you sell them before age 59 and a half, there's a 10% penalty and it all becomes ordinary income. So it's very expensive. So we divide our portfolio between taxable and retirement just because we have to manage the retirement assets differently. So what's our next exposure? We want large market cap index funds and ETFs. We want exposure to our largest markets. If you're a US student, it would be exposure to large cap. If you're from Hong Kong, it would be the Hong Kong Stock Exchange. Whatever the largest market there is, because generally the largest markets are the least risky. The large caps are the least risky. And then what do we do next once we have that exposure? Then we want to broaden and diversify, or broaden and deepen your asset classes. So let's say if you're a US student, you've already got US large cap, you might want to add small cap. You might want to add real estate investment trusts, something like that. So you're deepening within the US markets. Or you might want to broaden. You might want to go to international. Or you might want to add some emerging markets, things like that. And then the last one is, we call it opportunistic. You never have to go to this stage if you don't want to. But some people, they like to buy it. They want the thrill and the work of buying individual stocks and bonds, and that's fine. But do it after your portfolio's reached $750,000. And so we'll talk about that there, but opportunistic. So what does the bottom of the hourglass teach us? Remember, at the top of the hourglass is put priorities in order. So what does it teach us? It teaches us 4 important lessons. Number 1, actually 3 plus a note. It helps us keep risk in perspective. We started investing from the lowest risk, and then we move up higher and higher risk. Number 2, it teaches the how-to about investing. Again, you first invest in lower risk asset classes, and then you take on more risk as your asset size and your experience increases. And the third thing is it separates out taxable and retirement assets. These should be managed differently. And again, I reiterate the point that I made. It also lets you know that you can have a successful portfolio and never buy individual stocks and bonds. So you only have that. We call that opportunistic because you only do that if you want. Okay. So that's guidelines for building the portfolio. So now what about selecting individual assets? How do you know what to buy? So what's the difference between mutual funds, index funds, and exchange-traded funds? Christine? Okay, so let's just do a quick review.
Wait, who knows? Who knows? Somebody else? Somebody know the differences between? Okay, that's fine.
Quick review. Mutual funds are professionally managed portfolios of financial assets. You can have a bond mutual fund or a stock mutual fund, emerging markets mutual fund. My 2-cent claim to fame is my partner and I started the first no-load open-ended mutual fund for emerging markets. That and a quarter will buy you a cup of hot chocolate. So professionally managed, they can either be passive or active. And the other thing about those two is they only trade once a day. So as of 12:30, when I worked for Montgomery, we would calculate up all of our assets, subtract all of our liabilities, divided by the number of shares, and that gave us our net asset value. And people would come in, would buy at that net asset value, and people going out would sell at that net asset value. So mutual funds, just again, professionally managed, they can be active or passive. If they're passive, these mutual funds are now index funds, meaning their goal is not to beat an index, but to track an equity or bond index, such as the S&P 500. So they paid me when I was a mutual fund manager. I'd fly business class. I'd stay in 5-star hotels. I ate 5-star foods. I was expensive. But I mean, what do you have to pay for an index fund? It's a computer that runs it. So, and then what are ETFs? ETFs are mutual funds, and they can be index funds, but they just trade throughout the day. So there's a few other differences too. In order to buy an ETF, though, it costs money to buy and it costs money to sell. So those are the main differences between those three things. When we retired from doing asset management, Sister Sudwick noticed that we had a lot of funds, but all were funds that our company managed. And she says, you know what? They're not doing as well as the benchmarks. Some years we did, and some years we didn't. She says, you know what? Why don't we look into something else? And I wasn't too happy with that because these were all my friends. But I went through and I was talking to one of my friends who worked for Schwab, and he said, I told him what I was looking for, and he says, you know what? There's something you might think about. And he said, it's a new thing called an index fund. And I said, what's an index fund? And he says, well, their goal isn't to outperform a benchmark, it's just to match the performance of the benchmark. And I told him, I said, you know, I want a fund that I can hold for 25 years and never have to worry about it. I want it to be low cost, I want it to be tax efficient, I want it to be able to walk away and forget it. Set it and forget it. And he says, well, you ought to look at this. And Sister Sudwick looked at it, she said, I like this idea. So we did, and guess what? Today, you know, we'll share with you that index fund that we bought 25 years ago. And over the last 25 years, it's been in the top 25% of all large cap funds. So why do we recommend you invest in no-load index funds or ETFs? Lower cost, lower fees, lower risk. If you buy individual stocks, the risk is really high. If you're buying a portfolio of 500 stocks or 2,000 stocks, that risk is reduced. Lower fees, no-load funds, tax efficient. You buy individual stocks, you know, you're not diversified. You buy an index fund, you're immediately diversified. Again, consistent long-term performance, compound growth. And I like just the convenience. I don't have to worry. I was just looking at my thing, the stock market's down 2.4% today. Not a good day in the stock market. But you know what? I know exactly what I'm doing. You know, I know what the fund's doing. I accept that there's going to be volatility. Metzli.
So when the stock market drops, is that a good moment to buy?
Yeah, and if you're buying...
It is, but we normally just leave it and then it goes up.
And so generally what we do, when we had a job, we were putting 20% in. So every month we were buying. So when the market went down, we bought more shares. And when the market went up, we bought fewer shares. But now that we're retired, we can't buy anything. So yeah.
We just use it.
So the question is, where do you find information on bonds, stocks, and mutual funds? Lots of different sources. Mutual funds, supermarkets. These are the big guys. Generally, I recommend going with the big guys, just because they have good systems, they've got good support. You've got mutual fund monitoring companies like Morningstar and Lipper. You've got financial websites. Today, what we're going to do is we're going to give you some information on companies that we've screened through. But then you're going to have to go in and go to some of these websites and try to learn a little bit more about these funds.
They don't have to.
Yeah.
You don't have to.
Yeah, you don't have to. What's the best format for the information? We like it in a database format, so you can search it. Because ideally what we want, we know, we've talked about what are the principles of successful investing. So if we can apply those principles to these screens, then it will allow us to see companies that actually meet those principles. So Morningstar is what we use. It's just a provider. It's called Morningstar Investment Research. Normally $250.49 a year, $99 for teachers, $25 for students. We decided that this is a personal finance class. We don't want you guys to spending money that you'd $25 and you'd only use it for 20 minutes.
And you don't even need to do the 7-day free trial. Just don't do it. You don't need to. We screened it for you. You can look at what we did.
We shared on Tool 28 using Morningstar to select funds how we did it. Tool 29, we just gave you the results of those, and then we'll share those with you today. Again, what is it? It's a tool. Later on, as you get more into this, you might decide to get a subscription and to work on it there too. So how do you pick your mutual funds? Number one, you determine your asset classes and benchmarks. The good news is you guys did this on Friday. You've got your asset allocation from Tool 18, what percent goes to bonds, what percent in stocks, which asset classes. Number two, you determine what makes a good mutual fund. We've already talked about those. We didn't emphasize that in class, but you've been able to read that. I encourage you to read the readings that we give you. I mean, there's pages. Today we're talking about a lot of things. There's a lot more detail in the background readings that we gave you for today. And three, using a database program, set principles and evaluate. So what we've done is we've actually used that database program and we've come up with mutual funds that have come through those screens. And then you have to choose your funds and for each asset class. So criteria for a good mutual fund. Again, we just use three criteria. Number one, low cost. Two, turnover, performance. So slides here, what we wanted to do is I just gave you some information from the Morningstar website to help you. So low cost, what's low cost? It means no sales charges. It means low management fees. We like mutual funds which are cheap and management fees less than 0.2%. 0.2%, actually the ones I like are 0.02%. So we like funds that charge very little. So where do you find it? So this is from Morningstar. This is what the website here. Notice this fund. This is the fund that I told you 25 years ago that I wanted to buy and I wanted to hold it for 25 years. Well, we're getting almost to the point where we're right at 25 years. Notice debt expense ratio, 0.02%. 0.02% means if you have $100 there, you're going to pay 20 cents a year in management fees. That's really cheap. Notice compared to the large, all the others in the large blend or the large cap stocks, 0.80. So they're 1/40th, 40 times cheaper than these other ones. For you to make money, this fund only has to go up 0.03%. For this one, you have to make money. The fund has to go up 0.81%. So realize that's why we like low cost.
In order for the company to make money.
Right. In order for you to make money.
Oh, you to make money.
Yeah.
Because you pay them the 8%.
That's right. So low turnover and tax efficiency. You want to keep taxes low. Realize if you have a fund that buys and sells a whole bunch, a mutual fund is what's called a pass-through vehicle. Every time they sell something, it creates a taxable event for you. And every year you get a 1099 div for your distributions, for dividends. So if they don't turn over a lot, it's really tax efficient. So look at this fund here. They turn over 2% per year. So if you take 100 divided by 2%, that tells you on average, they hold their stocks for 50 years. That's my type of a mutual fund. So again, it creates very little. You can see the category. This is basically 1/3 what the category average is.